What's up everyone, it's Scotty with Money Investing. In this video, I wanted to go over some very interesting and important data, which does suggest that we gotta really prepare ourselves for what is to come in remainder of 2023. So hope you guys enjoyed this video and find it helpful. Make sure that you drop a like. Don't forget to subscribe to the channel if you're just joining us for the first time. The link to our Discord and Patreon is going to be down below. There is a 16% annual discount that's available for another 4 days. So today's April 26th. So April 30th is when that annual code or that annual discount expires, so you can take advantage of that. Link's going to be down below. You'll get access to all the buy and sell alerts, options alerts, trade ideas, all the private videos, including private live streams 3 days a week. So link's going to be down below. So this right here is the chart of M2, which is going to be money supply. So you can see that money supply has been contracting, and in March, the number that we just got was a decline of 4% on a year-over-year basis. This is the biggest decline in over 90 years. Yes, you heard that right. In over 90 years, the M2 has not contracted this at this level, right? So M2 hasn't contracted in nearly 90 years. And the last time it actually went through a contraction very similar, I don't want to say it, but that led to a depression in the US because money supply absolutely got demolished, and as a result, consumer spending, the velocity of money, it wasn't exchanging hands, and as a result, the entire economy was halted and went into a depression, pretty much went into reverse. So very important data point to look forward to because, CPI inflation, it is lagging. And of course, the Federal Reserve is looking at some lagging indicators. So if they do raise another 25 basis points in May, that is, again, going to put some more additional pressure on the banking sector, on the credit facilities, on just the liquidity of the entire market because they are, once again, taking liquidity out of the economy. If they continue to take liquidity out of the economy, that is eventually going to create a bigger and bigger problem for the economy. And again, economic recessions are very severe, right? They can be very severe. They can be mild, but they can also be pretty severe. And if you do see a severe economic recession, that's going to also result in earnings. That's also going to result in the markets, equities, bonds, all those different types of markets, which are also going to get affected. Now, speaking of the dollar, there's another chart, which I feel like there's not a lot of conversations being had around it. This right here is the US 1-year sovereign credit default swap spread. In other words, investors protecting against a US defaulting on its debt obligations has now skyrocketed. As of 2023, more specifically as of April 2023, we have seen a significant moonshot for this particular instrument as investors want to hedge against a potential US debt default. The debt ceiling is tapped out, so we're under extraordinary measures until the first week of June. So we've only got less than 45 days for the US to come together and raise the debt ceiling. That's the only solution they have. And it's been raised plenty of times. I've done several videos on the US dollar and the US debt and the whole situation, the whole mess really that the US is in. Make sure that you do check out those videos, but this is also going to be very important. And that's one of the reasons why I also do expect the dollar is going to continue to weaken in 2023. So Genevieve also posted, good morning everyone, is the US going to default? The US 1-year sovereign credit default swaps just hit a record high. This is the cost of insuring the US Treasury bonds against the risk of default. Worth noting that the US now has a higher default risk than China. Think about that for a second. I mean, we are seeing some unprecedented indicators just going at these crazy levels, including the money supply contracting severely, which can result in a potential depression. And if that happens, what is that going to do? That's going to force the Federal Reserve to increase quantitative easing. That's going to flip those gears once again, and the Federal Reserve is going to come in to support the economy. And quantitative easing, what does that do? That creates money supply. If there's more money supply, what does that do to the dollar? Continues to weaken it, right? And the only way the Treasury Department and the Federal Reserve, the monetary and fiscal policy, they can provide the dollars to the US consumers to spend to get out of that recession or worst case depression is by printing more money, borrowing more money, which is obviously going to create more pressure for the US debt ceiling. So it's all intertwined. It's all a big web, which unfortunately is now it's literally knocking on the door right now. This right here is from Lizanne, pretty much tweeted that just as large speculators, hedge funds have built largest net short positions for S&P 500 futures since 2011, leverage investors have also boosted net short position on the U.S. 10-year Treasury futures orange on the record. You're pretty much at a record here. So what we're also seeing is U.S. 10-year Treasury positions, net short positions have also hit a record, as well as a net short on U.S. equities. So both bonds and equities, they are net short since on record, on a very, very significant time, right? So for equities since 2011, for U.S. Treasuries, especially 10-year Treasuries, on a record. So what that really does, I mean, if 10-year yields start to go up because U.S. is now, let's say that it's perceived as higher risk. So higher risk equals higher reward. So if investors want to hold on to U.S. Treasuries, they're going to be willing to pay a higher interest, right? U.S. is going to want to pay a higher interest because of that higher risk that it now starts to carry. So higher rates is going to decrease the value of the bond itself, which means, bond prices will come down, yields will go higher. So that's the inverse correlation there. And right now we do have large speculators, hedge funds building largest net short positions in both equities and U.S. Treasuries on record. This right here is from Tom Lee. So I wanted to go over, what his perspective is. Of course, he is almost always bullish, but he mentioned that they still expect a dovish 25 basis point hike in May. And they mentioned that today's market selling pressure remains on a hair trigger, and today's wobble probably due to the First Republic Bank and regional bank model concerns. So, we obviously did have First Republic Bank dropping over 40% on the day, and they expect more regional softness is going to be another factor, and other is lots of disinflation in the pipeline. So Case-Shiller showed upside surprise on a month-over-month basis, but arguably as important is home prices went to zero year-over-year. So home prices are coming down. In fact, I think they were down to 3% on a year-over-year basis in February, and I think in March as well. But Redfin net rents are down year-over-year. So this is very similar to what Jeremy Siegel's also mentioned in his report, where rents are down on a year-over-year basis from Zillow, Redfin. So we are very much lagging behind CPI, and CPI is still showing an 8.6% year-over-year gain for housing. So it is lagging in real time. And food commodity index, so food prices have also been coming down, and they are down about 21% year-over-year, and now 4 months of negative year-over-year territory. So these right here are food price index, which Tom Lee also suggested that they are down. Now, he also tracked the lagging effects of inflation with food price index, and that is on average by 7 months. So meaning declines in food CPI, you could see that before the year end, and packaged food companies are sneaking in price increases. So it could be taking longer for Pepsi, Procter & Gamble, like for some of those companies, but it's evident that their margins are expanding. So in other words, we could start to see food prices come down, rents come down in remainder of 2023, especially when you've got money supply contracting as well. And this right here is just a little bit over CPI weight. So, and I want to go over the S&P 500, of course, declines around a U.S. recession, because with the money supply contracting the way it is, we've got the higher probability of a U.S. defaulting on its debt and getting a re-rating on its credit, and then not to mention the unemployment rate with all the layoffs that we're seeing. It's not just now contained in tech, but we've learned from McDonald's, we've learned from Disney, we've learned from so many companies, even First Republic Bank and a lot of banks that are now going to start to lay people off. It is going to trickle into some of the other sectors of the economy as well. And I have no doubt in my mind that employment is going to start to weaken. Unemployment is going to start to go up as a rate moving forward. So if this leads to a recession, which obviously this could be the most anticipated, most expected recession in the U.S. economy, but if this leads to one, we have to understand that a mild recession only creates a 23% downside for the S&P 500, which you might argue is already out of the way, right? From back in January 2022 to October of 22, we pretty much saw the markets down 22%. So we saw a bear market for the S&P 500. But if we do end up seeing a severe recession, and we're talking the likes of 1937, you can see over here, that was a Great Depression, right? So if you do end up seeing that, then obviously it's going to lead to lower earnings, more significant selling pressure, and a severe average decline is 43% in a severe recession. We're talking the dot-com bubble, 2001. We're talking the great inflation of 1970s. We're talking the housing bubble of 2007. And we're talking the Great Depression of 1937. So if this ends up being a severe recession, we are nowhere near close to an average decline of 43%. But if it still remains contained and there's a mild recession, 23%, I think we can argue that this is already out of the way and there's going to be lots of buying opportunities. I mean, there's going to be a ton of buying opportunities because the U.S. Economy is going to start to weaken. The Federal Reserve is going to pull back. They're going to start quantitative easing. The debt ceiling is going to be raised. And in that environment, you're going to find a lot of quality assets to buy for cheap. And of course, take advantage of that quantitative easing, once again, catapulting the markets back to higher highs and higher lows, and of course, potentially all-time highs. But if there's a more severe recession, then we got to be ready with more cash and liquidity to take advantage of bigger and better deals. So I hope you guys enjoyed this video. Let me know your thoughts down in the comment section below. Just wanted to break down some of these really important economic indicators that are really a bit concerning, but just wanted to bring that up. So let me know your thoughts down in the comment section below. And even 1929, you can see that it was pretty brutal. I believe 1929 was the time when there was Great Depression, 1929 all the way till 1930s. But this right here, you can see the drop was even worse than over 80%, 90%. So again, that is going to be all the way down here at the bottom right. So again, hope you guys enjoyed this video, found it helpful. If you did, make sure that you drop a like. Don't forget to subscribe to the channel if you're just joining us for the first time. Link to our Discord, Patreon is going to be down below. As always, happy investing. I'll see you all in the next video.